Hi guys, Karen here and welcome back to another video. In this particular video, we're going to talk about a unique opportunity that is time sensitive, something that's happening on the 17th of December to the 4th of January. So stay tuned until the end of this particular video to understand what is this unique opportunity that we are talking about. Now, if you have yet to like this particular video or even subscribe to our channel and click onto the notification button, now is the time to do so, because from time to time I'll release a particular video that is sensitive to the particular duration or to the specific time where you want to implement and take action to capitalize on the opportunity. Okay? And if today you're not subscribed or even click onto the notification button, you might miss out on the profitable opportunity, and this is a very cold hard truth in the financial market. If today you are snoozing, you're losing out on a profitable opportunity, right? So I want to inculcate that into you guys when you're watching this video as well. Okay. Now, what is it exactly that we are talking about over here? Okay, so now a lot of times traders and investors, when they are trading, they are either based on fundamental, they are basing it on technical, perhaps sometimes they look into the sentiment as well. Okay, they are all fantastic methodologies to trade and invest in the financial market. But this particular strategy or this particular way of analyzing a trade is not very common out there. But it's actually very easy because our decision is all based on historical statistics, data, and there's no guesswork. Okay, so I want to share with you a little bit about this statistics over here so that you understand, you appreciate this idea, and I'll share with you what exactly this instrument is. Okay, so now this particular instrument here is based on the statistics of 91 years. So it's not something that is just based on the past 1 year, 2 years, 3 years, or even 5 years. It's based on the 91 years of data, and therefore the reliability of it is pretty solid, right? Something that has happened for the past 91 years, we are analyzing that particular data. Now, in this particular instrument, between 17th of December to 4th of January, this particular stock or particular asset actually rallied by 1.82%. Now, you might start to ask, like, Kayong, why are you sharing me an idea of just rallying of 1.82%? That doesn't sound very interesting. It looks very low in return. But before you jump to that conclusion, I want you to understand that we are talking about 1.8% in just 17 days. Okay, and if you are taking away the weekends, okay, so that's about maybe 2 weeks of trading, and you are able to gain 1.82%. Isn't that fantastic? It's less than a month, and if you invested in it, you are able to generate a 1.82%, close to 2% return. That's fantastic, right? And of course, if today you're actually going to annualize this 1.82 within 17 days, that's equivalent to about 47% return in an annualized return data. Okay, now versus the remaining days in a year. So in a year you have about 360 days. You take away 17 days, that's about like maybe 340 plus days, right? The remaining 340 plus days, if you annualize it, the return is only 3.9%. Now what does this mean is even more interesting, because what it means to you is that within this 17 days, between 17th December to 4th January, okay, this number looks small, but actually if you look at the annualized data, it contributes to way more than the remaining days that you're going to see in the calendar year. Okay, so this particular instrument, in fact, if you really want to pay attention to it, this particular instrument, this particular period between 17th of December to 4th of January is a period where you want to emphasize and keep an eye on, focus on it. Okay. And of course, then the question that you generally ask is, okay, Kayong, then how accurate is this, right? What is the reliability factor? Now, based on 91 years, okay, there will be 73 years that the stock actually rallied. Okay, of course, it's not going to be 100%. There will be years where during this particular period, the particular instrument doesn't rally, right? It drops. So out of 91 years, there is 73 years it actually rallied. Okay. And if you convert that to a percentage of accuracy, that's close to 80%. So that's fairly reliable. Okay? So what does this mean is, of course, out of 91 years, there will be 73 years that rally, there will be years that didn't rally. if you average that out of 91 years, the average return per year within this period here is about 1.82%. That's pretty good, okay? So what is this particular instrument? So this one here is, of course, we talk about the S&P 500. Now, I'm not sure if you're aware of this term that many perhaps traders, investors are using or even talking about in this particular period here. They call it the Santa Claus Rally. Okay, it's actually a phenomenon. Okay, and a lot of traders only talk about this phenomenon, but they do not have like statistics and data to back up whether the Santa Claus Rally is real or not. Okay, who knows? Some years Santa Claus knock on your door, present you with a gift, and then some years it doesn't, right? Aww. So we do not know, but the idea here is we know there's a good chance, about 80% chance Santa Claus will arrive and give you a present. Okay, so the idea here is, you might hear of that term, but what is the fundamental drivers that causes Santa Claus Rally? Generally, there are two ways to look at it. Okay, the first reason here is perhaps we're talking about window dressing. So what is window dressing is you need to understand that most fund managers or even investors and traders, when it comes to the end of the year, they like to polish up their portfolio a little bit to make it look nicer, to pump it up a little bit. Why? Because their compensation, their commission, how much they make actually has a direct result of how well their portfolio is performing. Right? So when it's coming to the end of the year, they would like to push it up a little bit so that they'll be able to receive what we call like a bonus, right? So that is what we term as window dressing. Now there's another factor here that you can also use to explain the Santa Claus Rally. It's more towards the crowd psychology. Okay, Christmas and New Year, this is the period, right? And we are in a festive seasons where we like to go shopping, we like to be buying stuff, presents during this period, and of course that behavior is also translated perhaps buying, shopping, but not your typical products, but in the financial market, right?
Let's go shopping, let's go shopping, let's go shopping, you and me.
So that also translates towards higher demand, more people entering the market, buying up stocks. That pushes up and what we call the Santa Claus Rally. Okay, so instead of just understanding, oh, this is the phenomenon called Santa Claus Rally, it tends to rally during this particular period. Today in this video here, I want to present to you a hard statistics, a cold hard statistics, so that when you have all this with you and you start to make trading decisions, you actually feel that you're making a more informed decision. There's no gambling, there's no guesswork, there's no like, I think it is, okay, because what we are looking out for is number one, it has 80% accuracy, that's pretty reliable. Number two, we know the exact date that we are holding on to this particular investment. From 17th of December, we are going to enter, and of course, 4th of January, we're going to exit. Okay, and we have an expected target here to hit. So this is an average of 1.8. Now, does it mean that every year you're going to get 1.8? No, some years you're going to get maybe more. Some years maybe it's a losing year. But the idea here is you average out. You do it consistently every time. You're going to get an expected return of about 1.8. Okay, so that's the S&P 500. Now, to give you more bonus, okay, if you stay and watch all the way until this video here, I hope you actually benefited from this idea. You get a better understanding and appreciate, the statistics that's presented to you. Remember to smash the like button, and if you've not yet subscribed to the channel, make sure you do that. Okay, and if you watch all the way until here, I would like to give you a bonus. Okay, and this bonus here, of course, is related to statistics as well. And over here, we call it the seasonal trade ideas. Now, the other instrument that you want to pay very close attention, starting from now, depending on when you watch this video, of course, but starting from now, mid-December, somewhere around 17th December, that's mid-December, right? Somewhere from now until the end of February, you want to pay very close attention to a specific sector called the precious metal commodities. So this includes your gold, silver, platinum market. Okay, and during this particular period, these commodities, precious metal commodities, tends to rally. Now, there's a very strong fundamental reason to it. Number one, okay, during the end of the year, that's where companies will start to order in bulk for the next financial year. Okay, and companies that deal with industrial usage, production, construction, will require these commodities, okay? Mainly silver and platinum. Of course, gold will also be involved in it. So now with that understanding, okay, with that fundamental drivers, that's where it tends to push this particular commodity, the precious metal commodity sector, up during this particular window or period. Okay, so that's an opportunity for you. Now, on top of that, I want to give you my personal view going into 2021 as well, because it's a unique year, right? We are in 2022 with pandemic, with global economy closing down, with the central bank lowering interest rate, printing money. Okay, this is where a lot of investors and even traders are talking about a potential inflationary pressure and how to actually hedge against a potential devaluation of a currency. Now, one of the most common money flow concept over here that you want to take away is that when the currency starts to devalue, investors and fund managers would like to seek out for how can you convert cash position, currency position into something else to protect against inflation. Okay, and one of the most common asset here that you want to consider is gold and silver, precious metal in short. Okay, so now on top of just that typical year-on-year, you have that fundamental driver. Now you do have another factor here to consider where we have a potential devaluation of currency. Because of inflationary pressure, we want to park our money towards commodity, and gold and silver is one of them. Okay, so that's the second one. Right, so not only do we have a statistics and data to back us up between mid-December to end of February, what we also observe is this year moving forward into 2021, we do have a unique situation where the fundamental forces do push the money into the commodities market as well. So definitely what you want to do, of course, is not to just blindly follow. This is not meant to be a trade call. But I want to bring your attention, if today you are not looking at them, I want to bring your attention towards the precious metal market, the commodity sector, which is gold, silver, and platinum. Okay, do start to pay attention to it because I believe personally that there are huge opportunity presented in this three commodities market. Okay, so I hope this video here gives you some unique insights that is able to help you in your trading investment journey. Okay, and of course, if this whole idea of recurring pattern, looking at statistics, interests you, okay, I'll drop a link below towards our website called the Seasonal Trade Ideas. We share all these ideas backed by statistics, by empirical data with our students, with our traders, in terms of what is a specific stock to enter, what is a specific date to enter, what's a specific date to exit. Okay, so I'll drop a link below if you're interested. Click onto it, find out a little bit more, and of course, right, all the time, if you have any questions, you would like to clarify on certain things, feel free to drop them in the comments below. Okay, I'll look through them and answer your questions accordingly. So with that, I hope you enjoyed this video, you benefited from it, at least take away something, and with that, I'll see you guys in the next video.